we'll push it back out, but we'll go ahead and get started. Thanks to everybody for coming to the Upper Tampa Bay Chamber of Commerce Economic Development meeting. My name is Doug Vivas, and we're excited to have Vince Albanese and Jonathan Field with us today to share some, hopefully some opportunities that may get some money for you. It's Jonathan Field with Emerge 180 is going to discuss the Employee Retention Credit Program. The Employee Retention Credit Program is part of the federal stimulus package and could be worth up to $33,000 per employee. This is real tax-free cash for your business that does not have to be repaid. So I know, Vince, I'll turn it over to you to kind of tee it up for Jonathan, if you will.
Sure. Thank you very much. Good morning, everybody. So I'm a part of the Oldsmar Neighborhood Association, and we're active, happy new members of the chamber. So thank you, Doug, for allowing us here. There is an exciting movement underfoot in the community to get federal cash back to small businesses. That is a complex undertaking that intimidates many, but the cash has already been allocated. The government is interested in having navigators, community navigators. They're actually spending $100 million to figure out a way to do it, and we already have this with the Upper Tampa Bay Chamber. So we have personally benefited from this. Cash is being awarded, and the best thing about this is that we've worked out a deal with another great local up at Tampa Bay company called Emerge 180 in order for them to be able to donate back to local projects. So this is truly a virtuous circle where everybody wins. But to get through the complexity, Jonathan is an expert, solid Tampa Bay citizen, our West Point appointee back at one time. So I've known him a long time, and I'm very happy to have him here. This is good for everybody, good for small business. So Jonathan, take it away.
Well, thank you, Vince, and thank you, Doug, for putting this together and hosting it this morning. If you could, Doug, share the screen so we can go into the presentation. So while he's doing this, just I do appreciate everyone being here this morning. I'm going to go through in great detail the background of the program and really spend most of our time on eligibility, which is where we get most of our questions. Some of you may already be familiar with the Employee Retention Credit Program or have maybe looked at it personally for your business. So I'm going to run through a series of slides, but certainly want to leave plenty of time open for questions at the end, either directly for your business specifically or more of in a general sense. So
you should have share screen, I think. So
all right, here we go.
Yep, there we go.
Oh, so can everyone see it says in big white letters, the Employee Retention Credit Program?
Yeah.
Yep.
Good.
Yep.
All right. So without further ado, just a quick on the agenda. We're going to spend most of our time, like I said, on the Employee Retention Credit. There are a couple things that I want to highlight in addition to that, specifically the SBA Disaster Loan Program, also known as the Economic Injury Disaster Loan. So many of you probably have heard about this or maybe have already received those funds, but I do want to highlight it because we get asked questions about how they interrelate with the Employee Retention Credit. And I also want to spend the last few minutes talking about the Ppp Loan Forgiveness process because it is directly related to the Employee Retention Credit. And there's some tips that we offer in terms of helping people maximize the federal programs. And I hope many of you or all of you have been able to benefit from a PPP loan during this process. Just a little background on Emerge 180. As Vince had mentioned, we're locally based here in Tampa. I'm an old Clearwater Tampa boy from long ago. So, but we are licensed tax professionals all the way from bookkeepers, enrolled agents up to tax attorneys. We have a history long before this pandemic of specializing in tax credits and SBA programs. We've been doing tax credits for both small and large organizations, from mom and pop places all the way up to professional sports teams, some of them which you may know in the local area. And we've been doing this a long time, so we're not new to the game. And we are primarily small to medium-sized business focused. That's really our sweet spot. That's what we believe is what makes this country so great. Vince has heard me get on my little stump about the importance of entrepreneurship, of the small business owner, and just as a foundation of the identity of our great United States. So we're going to do a little bit of a history lesson on the employee retention credit. Interestingly enough, you'll hear it referred to both the employee retention tax credit and the employee retention credit. In the IRS's infinite marketing abilities, they decided halfway through to just remove the tax word out of it. So if you hear both, you hear me say both, it is the same thing. So briefly, the employee retention credit was actually designed as part of the first stimulus package way back when. I know it was only last year. It seems like a lifetime ago. And at that time, you could only choose the PPP loan or the employee retention credit. And 99.9% of the businesses out there chose the PPP. It was much better. It was much more easy to understand. You had all of the banks promoting the PPP. So really no one even talked about the employee retention credit at that time. And really the only reason why we are even here talking about it is when they passed the second stimulus package at the end of December of 2020. They significantly altered the employee retention credit and made it much more valuable and accessible for businesses. And there's really three things that we talk about that they fundamentally changed. The first and probably the biggest was they said you no longer have to pick a PPP loan or the employee retention credit. You can now get both. So that by itself was a huge deal. The second thing they did is they said, okay, well, it's the end of December. We're going to allow you to go back retroactively and get this credit back to March 12th of 2020. So you can go back in time and recapture those dollars. And then what they did is they extended it into 2021. And when they extended it into 2021, they nearly, they over quintupled the amount of that. As you can see on the slide, they went from a max credit in 2020 of about $5,000 per employee of cash back to a potential max of $28,000 in 2021. And that's broken up by $7,000 per quarter. And we'll go in with the following slides about what those max credits are, how it works, that type of thing. How do you achieve that? But as you can see, they made this a much more accessible and a much more valuable program to small businesses. Now, I just can reiterate, because I get asked this question a lot. When people see that word credit, they think it's typically a credit against future taxes, which in the normal IRS world, that's what it is. But this is a rare instance where this is real cash back to the business. I get asked this all the time. How am I going to get that money? Does it just show up? I kid you not. I know it's an old cliche, but the check does come in the mail. You literally get a check in the mail. In fact, I got a call just yesterday afternoon about a client of ours who was so excited because he got a check in the mail from the IRS for $112,000 specifically to this program. So, when we do this, I tell them after a certain period of time, start looking in your mailbox for a check from the IRS. It's about one of the few things you actually want to receive in the mail from the IRS. Just a couple other examples, just to give you an idea how valuable this program is. These are real examples. So on the left, you see it's a 702 employee healthcare entity. Now, in following on slides, you're going to say, well, there's a max of 500 employees. How did this company with 700 employees actually get this? I'll go into that later. But for them, just in this, they weren't eligible for the credit for 2020. But in the first half of this year, close to $5 million that we're getting for them through the employee retention credit. I will tell you this, the largest check that we've had a client receive to date is $1.86 million. So this is incredible money. It's real. And I can't stress enough how every business should be looking at this. And I'll go through like a really high level eligibility component that just to give you an idea of where you should start. The middle example, it's a restaurant. They had 3 locations, severely hit through the pandemic, had to shut down, very limited. But $635,000 they'll be getting through this program as a combination of last year and also this year. And then even a smaller entity with just 8 employees, And as you can see, they received 2 PPP loans, but on top of receiving 2 PPP loans, they're getting $137,000 back through this program. So no matter your size, as long as you meet the general requirements, this is significant dollars for a business. So we're going to go into the high-level eligibility requirements. It's not on the slide, but I typically say, if you can answer yes to these 3 questions, then you owe it to yourself or anyone you know that has a business to go through a more significant eligibility review. And those 3 questions are simple. Do you have 500 or fewer full-time employees? Do you pay W-2 wages? And were you in business prior to December 31st, 2020? Now, everyone here on the call, if you answered yes to those 3 questions, we need to explore further your specific eligibility for this program. But here's some more details on the slide. So because they have changed. So 2020 requirements are different than 2021. As you can see, in 2020, you need to have 100 or fewer full-time employees. You have to have the qualified period is from March 12th through the end of the year. And then you qualify either through being partially or fully suspended or a 50% decline in gross receipts. Now I'm going to go into great detail on what it means to be partially or fully suspended. But you can also see in 2021, they expanded the program. They went from only needing 100 or less full-time employees to 500 or less. All right. And then now they looked at qualified wages over a calendar quarter period as opposed to a longer period of time. And the other thing that they did is that they reduced the amount of the decline in the gross receipts to 20%. Now, a couple of caveats. Many of you have probably taken advantage of the PPP and explored maybe getting a second one. Hopefully, most of you were able to get that second one. But what you'll see is that in order to get that, they changed the PPP rules along the way as well. So when you got your first PPP, they had 500 or fewer employees to be eligible. Well, they reduced that to 300. So how the government works out some of these things, I'm not quite sure, but there's eligibility in there that some companies just couldn't even get the second PPP because of their size. And really, this employee retention credit program was their only and best option. Now, there's a couple highlights there at the bottom of the slide that I want to point out specifically. Now, a full-time employee, this is dictated by IRS regulation, is determined by someone who works 30 plus hours a week or 100 or 30 plus hours a month. And I'm going to point this out because we've had several clients that have come to us and said, hey, we're not eligible because we have more than 100 employees. Well, we've gone through and done an evaluation of their hours, okay, that they actually worked, and we've been able to qualify them based on the IRS definition of a full-time employee. I have a client out in California, 160 employees, right? They were originally told that they weren't eligible because of their employee account. But when we went through that review, we determined that they actually only had 70 full-time employees that were determined full-time by the IRS definition. We qualified them. Just for 2020 alone, they got over $500,000 through this program. Now, here's the benefit, right? You actually win on both sides. This is a rare instance where the IRS lets you win on both sides of this. So your number of employees, they need to be full-time by the hourly rate to count against that 100 or fewer or 500 or fewer, but you still get the benefit of all the wages that you've paid to part-time employees. So regardless of whether it's a full-time or a part-time person, you get credit towards those wages that you pay. That's significant, and it really enhances the the amount of the employee retention credit. Just real quick, a couple other highlights. Tax-exempt organizations are eligible. We're working with several large nonprofits, religious organizations, and the like. Employers in U.S. territories are eligible. Think Puerto Rico, U.S. Virgin Islands. Those businesses are available for this program as well. However, if you are self-employed or a 1099 where you don't pay W-2 wages, this program, it's against wages that are reported to the IRS as part of a payroll tax return. So that's how they determine the eligibility. And like I mentioned, the business just has to be open prior to December 31st. All right, so we're going to talk a lot about suspended operations because this is where there's the most questions, the most lack of certainty around who's eligible or not. And really what this is based off the CARES Act. This is also based off IRS notice 2021 that was released in March, early March of this year, and then followed up by 2023. But in order to be, one of the ways to be eligible, certainly there's the gross receipts or decline, but is to be under a partial or full suspension order. And what does that mean, right? It just means a government order, and this could be at the federal level, could be at the state level, could even be at the county level or municipal level, that limits commerce, travel, or group meetings. Okay, and we'll go through several examples on this. But it limits the hours of operations for a business. It limits the capacity of the business, whether it be a retail site or others, whether it includes shelter in place or whether there's even curfews. And so any order that actually limits the ability for a business to operate at full capacity could make you eligible for this program. Now, a couple things about this is, well, the IRS made it clear it's not whether the order is enforced or not, it's just that it is in order. And that's sometimes we get into some of the complexity of this. Now, many people also ask, well, I was deemed essential or non-essential. Well, we're qualifying many healthcare related entities that were certainly deemed essential. Even, for instance, Governor DeSantis made it sure that religious organizations were essential. However, they're still eligible because they weren't necessarily able to operate at full capacity, or they weren't able to operate their hours fully. We have many grocery stores that, small mom and pop grocery stores where their hours were limited, even though they were deemed essential for the purpose of the employee retention credit. And then certainly there's non-essential businesses that are eligible with the government order just by itself. Now, I do want to point out that if you do voluntarily suspend operations where you're not required to, that doesn't make you eligible. So if a business or a restaurant, say, has continued to limit its capacity even after there's no order in place, their eligibility is ended when that government order is ended. And I can give some specific examples as we go along. Hold on a minute. I can't see. There we go. All right. So as I mentioned, any business where a government order reduces capacity and/or hours of operations. So as I mentioned, those included grocery stores, gas stations. There's a lot of healthcare related entities where their hours were limited, even when they were essential. But it also includes, let's take restaurants or hospitality, right? So, they've had various levels of being able to open. So, until they're able to have dining in at 100% capacity, or until that time, they're actually eligible for this credit. And for local local restaurants, that could be as long from March 12th all the way up to May 4th of this year, March 12th, 2020, up to May 4th of 2021. However, that was due to local orders, not necessarily state orders. I can give you an example of a restaurant in Port Charlotte whose eligibility ended September 25th because in that county and in that city, they didn't enforce any local orders above what the state put in. The next one is any entity not able to hold meetings or meetings are limited. Most people think of religious organizations, and certainly that applies. If you're not able to hold a congregation at 100% capacity or that 6-foot spacing was enforced, that makes you eligible because you weren't able to hold a meeting at full capacity. But we also have been able to qualify Several other types of organizations, for instance, insurance agencies that are geared towards, they primarily work with teachers and their ability, and all they do is meet with teachers on site at the school. Well, they weren't able to conduct business because they weren't able to hold meetings at the school and they had to transition. Well, that made them eligible for the program. Businesses that rely on suppliers that are partially suspended. This could be as a wholesale relationship where you're not able to get, goods to sell. It also could be a manufacturer who's not able to get the raw materials needed in order to manufacture those products, and that has that downstream effect. This also includes, say, like restaurant supply companies that they could not operate because the restaurants, their clients weren't open. So you also have multi-purpose businesses where if one part is partially suspended. There's two examples that I typically think about here is, you have restaurants that did takeout, that did catering, and they did dining in, right? And their takeout business actually grew or improved over that time. And even they started to do catering, which didn't necessarily stayed status quo. But despite those two things, as long as they weren't able to have 100% dining in capacity, the entire business is eligible for this. All right. So if just one part of the business was affected and deemed eligible, it impacts the entire business. You can also think about this from a healthcare standpoint. Take a healthcare organization that has many different facets to it, where they're doing both elective surgeries and also providing essential care. Well, those non-elective procedures probably weren't being done or were significantly impacted by it. But if one part of that healthcare organization is eligible for it, whether it's limited capacity or unable to conduct it, the entire organization is eligible. We also make it clear that if you're a multiple location business, you're eligible just as long as one location is eligible. I was actually working with a large nonprofit that has several locations, and those locations were affected differently by local orders. Well, what we determined was one location made the entire organization eligible. And so you can also think of a retail location that has, say 4 or 5 different locations in different counties. Well, how the local order is done in Pinellas County may be different than it is in Pasco County, and then certainly maybe Hernando County. But as long as one location is eligible, it applies to all of the locations under that entity. Now, if you come to all of this and you still say, well, hey, I'm really not sure if I'm eligible, the IRS, they love tests. So in their infinite wisdom, they came up with what they call this comparable operations test. And there's 4 factors that go into it. And if you want, we can discuss it in more detail. But given that it's still, in the morning, I don't want to bore you too much. But the general take on this test is a determination to see how easy it was for your business to transition from working in an office environment to an at-home environment. So if you were one of those businesses that said, hey, we need to transition from our offices to at home, that's where this comparable operations test comes in to determine your eligibility, when it started and when it ended. Now, lastly, I'll just tell you this, a lot of businesses had to modify their operations, whether it was through, plexiglass shields, whether it was through spacing, those type of things. Those modifications by itself do not make you eligible. But by the mere fact that those modifications were put in place, most likely you're eligible under some type of capacity constraint. We're helping a lot of the restaurants in the Northeast that at one point in time, they were allowed to build these outdoor dining facilities or dining areas. But that by itself, building those didn't make them eligible, but the mere fact that they couldn't have the dining in did. So just a couple nuances to the program. So that's in general how you get the partial or full suspension of operations. And what we do is we take you through a very specific eligibility based on your business, your location, and what orders are in place. We've done so many of these that we have on some I can already, I can tell you instantly what you qualify for, but for others, we actually run you through this very specific program. So, and certainly, like I said, we can go over and, address as many questions as you'd like when it comes to the suspension component of the Employee Retention Credit Program. So, but what I want to do is just talk about what do we mean by qualified wages? Okay, so qualified wages basically are the gross wages that you pay to your employees, okay, not net, and it does not include your taxes that you pay on top of the gross wages. Strictly the gross wages plus any employer's portion of group health and retirement. That's what is included in qualified wages. All right, I can say that again. The taxes that you pay on the wages is not included as a qualified wage. Now, in order to maximize the amount of the credit, okay, they came up with this magic number of $10,000. Now, the $10,000, you have to get up to $10,000 in qualified wages for the time period in 2020 of March 12th to December 31st. And then they give you 50% of that back in terms of the employee retention credit. Now in 2021, they took that, they took that same $10,000 and they looked at it as part just on the calendar quarter. So instead of that whole period. And instead of giving you a 50% credit, they are now giving you a 70% credit. Now this is prorated. So if you have an employee and you paid them $8,000 in qualified wages for the first quarter of 2021, you're going to get 70% of that, or $5,600. So that's where it comes in with part-time or people who don't get up to the full amount of the qualified wage. You still get that percentage of whatever you pay them. Now, I get a lot of questions about how the PPP forgiveness works with the employee retention credit. Now, the IRS just does not like you double dipping, believe it or not. They'll tax the same dollar twice on you, but they don't want you getting a credit on the same dollar. So, little tax joke. Hopefully it didn't go over many of your heads there. So, but you can't use the same dollar. So if you use a dollar as part of a PPP loan forgiveness, you can't use it towards qualified wage. However, we're experts in making sure those two programs combine so that you can maximize that program. So, when people say, well, I used my PPP, I'm no longer eligible. Well, that's not the case at all. We look at the gross wages. We look at your combined qualified wages over a given period of time. We know how to allocate your PPP money. And then we also know how to fit the employee retention credit around this. I had a restaurant that was adamant that they weren't going to get any employee retention credit program because they had such a huge PPP loan and that they used it all towards wages. Well, once we did our analysis, just in one quarter alone, we found an additional $81,000 through the employee retention credit program. And so it's just a matter of knowing how to do this, how they truly work together, having the experience of working through these many hundreds of times. So like I said, though, you can't double dip. So any qualified wages you use in your PPP forgiveness package, you can't use for this program. And also qualified wages that you use for your employee retention credit are excluded from other programs. And that could be the PPP for any restaurants or hospitality groups out there. It could be the Restaurant Revitalization Fund. It could be the shuttered venue grants out there. So just be aware of those things. And here's a little caveat for some of you small business owners that employ family members. Now, this is what the IRS terms what's called an eligible employer, and there's very clear guidelines on this. But based on our experience and our determination, both with this program and with other tax credits, qualified wages include business owners and their spouses only. Okay, so if you're a business out there and you employ siblings or children or aunts or uncles, just know that you're only eligible for you and your spouse or significant other. Those other ones are deemed ineligible for the purpose of this credit, just like they're deemed ineligible for other tax credits that the IRS offers, just FYI. Okay, so how do you claim this, right? So how do you get this money back? Well, given where we are in time, the most, typically what we're doing is amending payroll tax returns. And so for some of you that might send out some red flags. They're like, wait, we got to amend something. I already got it in there. This is the IRS. I don't necessarily want to mess with amending the payroll tax returns. But let me tell you, this is about 90, 95% of us claiming this is looking at this retroactively. Certainly last year we have to do that. And now we're into the third quarter. So when we're looking at this for the first and second quarter, we are amending those payroll tax returns. But the good thing about this is we're not changing any of the basic foundations of that tax return. We're not changing the total amounts. We're not changing the total tax amounts. There's no need to adjust year-end tax returns such as the 940. It does not impact or make any play on it in changing W-2s for you or any of your employees. All we're doing is we're identifying and then going back and capturing the credit. All right, so I just want to make sure it's clear to everyone on that. Now you are able to also claim this directly on your original return. For the second quarter, we worked with several, dozens of clients in terms of drafting their second quarter 941 so that they're capturing it when they file originally without having to file an amendment. And for some of those businesses out there where cash flow is incredibly tight, and I know they're still out there, I mean, we've worked with them every single day. There's two options that the IRS has given you. Number one, you can request an advance in the current calendar quarter only for the amount you believe you would receive for that calendar quarter. So it's not like you can request it for all of the stuff in the past. Okay, so they do have this advance. It's called an IRS Form 7200. Now you also are able to, in the current quarter, reduce or eliminate your federal tax deposits. So if you want to stop paying your federal tax deposits because you believe you're eligible for this credit, you're able to do that. Now on the advance and also on reducing or eliminating your federal tax deposits, it's crucially important that you reconcile those on your original return. And so we help many of our clients with that so that everything is buttoned up tight, everything's done correctly, both, so that it's capturing that that credit or that, not paying those federal tax deposits. But you do have those options. Now I'm going to go over a timeline of when you can expect to receive this money. And this is where the one area where I would say, or the biggest area where this program, I think, is not as helpful to small businesses. Yes, it's true. It's a great program, believe in it fully. But if you're looking for getting this money fast, this program is not designed for that. I will say the PPP, they did a phenomenal job of getting that money out as fast as possible. Certainly by the second round, they even had to refine their processes. And you had this whole infrastructure of all of these big banks and medium-sized banks geared towards doing that. So that infrastructure was in place. The IRS is not built or designed like this. Now they're staffing up to help manage this program. We talk with them every day on the status of our clients, but this is a slow moving thing. It's kind of like I equate it. It's like if you want to, you want to turn around an aircraft carrier, it's going to take a long time to do that, as opposed to if you want to, turn around a 20-foot boat. But the point of the matter is, this is not, if you're looking for immediate cash relief, this has its limitations in terms of helping your business. Now, I will tell you, the best way to get this is obviously stop paying federal tax deposits. That's immediate, okay? But it's very limited in what it can benefit to you. The next thing is the advance. Now, what we're seeing is the advance can take up to 12 weeks to receive, which, kind of defines, it's kind of an oxymoron. If it's an advance, why does it take so long to get? That's just how the IRS is processing it. We are seeing our clients receive them as fast as 4 to 6 weeks, but on average, it's closer to 12. Now, if you file the employee retention credit as part of an original return, you're looking at anywhere from 3 to 5 months to receive that money. Still a long time. It's taking the IRS a while to process these. Now, if you file an amended return, which is the vast majority of this, it could take upwards of 9 months to receive that money. Now, we have clients starting to receive that because we've now been doing this 6 months. But what we're seeing in the trend that, in discussing with the IRS, it's taking them that long to process these things. So, what I tell our clients is, don't hesitate to do this, okay? There's no reason to not do this now. Let's get that clock started. And this is not on a slide, but I'm going to walk you through how the IRS takes this program. So once we submit it, let's take the amended payroll return. We send everything certified, confirmed receipt to the IRS. That's the only way you should ever send anything to the IRS. Believe it or not, they lose mail. So then as soon as they accept that, all right, they then enter it into the system, and it's just designated as being processed. Well, now that it's being processed, it then has to wait to be assigned to a team. Now that team is determined by the amount of the credit, the location, and business type of the entity. Now, once it's assigned to a team, then it has to be assigned to an individual. And then once it's signed to an individual, then you're looking at between 30 or 60 days for them to process that return for your business. So most of our clients, the longest period of time is sitting in a team waiting to be assigned to an individual for processing. So just an FYI on how much time that's going to take. So in general, this is how we handle our process. Once you sign up with us, we take you through another detailed eligibility review so that we qualify exactly the time period and how you're eligible. Then all we need is payroll data and payroll tax returns. We don't need any personal information, personal taxes, none of those things. And then we make that determination. We do our calculation for the ERC amount. So then we complete all of the applicable IRS documents. This includes both all the supporting papers, the worksheets, IRS worksheets, the amended returns, everything that goes into that. So we draft all of those things for you to review and then sign. Once those are signed, we submit everything to the IRS. And then the key here is the follow-up. So after we're submitted, that's why we're on the phone with the IRS every day. We're following up on the submissions. We're looking at this to say, hey, this has been sitting in this process for too long. When is it going to be assigned to an individual, so on and so forth. And then you receive the funds. Like I said early on, you're just literally going to stand by the mailbox and wait for that check to show up. Now, I will tell you things. Another question that I get asked is, well, what happens if they have questions about what we submitted? It's a great question, right? Or what happens if there's something wrong with the submission? I will tell you this, all of that is going to be addressed when it's with the individual who's handling the claim. So if there's any questions on what we submit, we get them when that individual, that IRS that's been assigned to review this, has the file. Now, once they release that, okay, then that money goes out to you. But when there's questions about timing or amounts or eligibility, that's when that happens. So we're addressing the vast majority of any issues are being addressed prior to you receiving those funds. Okay, so this is just an overview of the benefits for your business. Like I said, it's a max potential credit of $33,000 per employee. This is real cash back. Okay, this is not a credit against future taxes. You do have other options to help that could provide immediate relief for your business. Now, there's no income tax implications on this. You're not being taxed on this money. And I can go into that in more detail if you'd like. There's no forgiveness process. The PPP, you then have to file all these forms with your bank, and then you have to wait for the bank to approve it, and then the SBA approve it to then actually truly to be forgiven. You receive this money, there's nothing further you need to do. And this is another key point. There's no requirement on the use of funds. Okay. Once you receive that money, it's yours to do whatever you want with it. You can put it back into the business. You can pay your employees. You can go on vacation. There's no limitations. This is why I often refer to people as like, think of it as a refund, not a tax credit. Okay, that's how you should look at this. Even though technically per IRS guidelines, it is not a refund, but that's how it should be treated in terms of the purpose for you. You also have the ability to offset previous year's tax burdens. We've helped many clients with this and nobody wants to owe the IRS, obviously. So this is a great program. If you got behind on your taxes, we can use this to actually clean the slate with the IRS. And frankly, one of the benefits of this is we handle the entire process from start to finish, from eligibility to actually checks in the mail and even beyond. If there's any questions after you receive it, we're with you the entire way. So real quick, I wanted to discuss the SBA disaster loan overview. I know many of you have probably already done this. I just wanted to highlight a couple things. It's a great program. They are coming to an end with the money. So if it's something you haven't looked into, you should look into it. The max loan amount is now up to $500,000. Last year in 2020, they had limited it to $150,000. And if you only got the 150, you can go back and request more. Now the terms on this are great. It's a 30-year term. You know, you're paying 3.75 for businesses and only 2.75 for nonprofits. The ability to get this money, the ease of the process and the terms are not something that I've seen in my professional life. And not only that, the first payment is deferred for 24 months. When they started this program, they only deferred it for the first 12. They've now moved that up to 24. Now the process does take a long time. When we started doing this back in, they changed the guidelines back at the beginning of April. It was about 30 or 60 days. And you now can expect that to take 90 to 120 days. So if you haven't applied for this or haven't applied for an advance, I would move quickly to do so. There is a targeted EIDL advance that's still available. There's several requirements that you have to meet in order to get that. And the use of proceeds are pretty broad, but you can use them for a variety of things. I tell people is even if you don't know how to use the proceeds right now, think of it as one of the cheapest, best insurance policies that you could actually ever get, because this is real cash that you can have on hand. If you end up not needing it or using it, there's very little cost of capital for this. I apologize, my screen seemed to have frozen up here. So here we go. Some basic eligibility requirements: 1,000 or fewer full-time. You need to be located and primarily operate in the United States. Now here's one where you have to be open prior to March 11th of 2020. And there's a list of ineligible businesses that you need to kind of review in order for this. Now, just to caveat, personal guarantees are required on anything over $200,000. So if you're looking at this, just realize that you are going to have to personally guarantee that. However, nonprofits get a break. They're not required any personal guarantee, even up to the full $500,000. And unlike the employee retention credit, sole proprietors and independent contractors are eligible for this. Now, it does need to be paid back. It is a loan, but it is still a good program. Okay, I'm going to end with PPP loan forgiveness. And some of you have already gone through this process. Some of you went through it with your first PPP and now have a second PPP. But I want to just give you a couple of tips, a couple of highlights. You may know these already, but I can just tell you this from our experience in working with a lot of businesses. How you address that loan forgiveness process has a significant impact on the amount of the employee retention credit. Now, you're only required by the SBA to have 60% of the amount of that PPP loan actually go towards payroll expenses. The other 40% can go to non-payroll expenses. Now, those are typically rent, supplies, or mortgage. But this is key in order to look at this and know the difference between your non-payroll and payroll expenses. Now, if your loan was above 150,000, you're required a regular application. If it's under 150, it's called a simple application. And I will tell you this, most banks, regardless of the amount, are putting in requirements that are similar for a regular application, just out of an abundance of caution. Now, the deadline for filing your loan forgiveness is 10 months after the end of the covered period. So let's say you got a second PPP loan and you got it in January, your covered period ends in July of this year, or you have 10 months from that point to file for forgiveness. So there's a significant period of time. Now, as we mentioned, you can't double dip. Payroll expenses for PPP are excluded from the ERC and vice versa. But the key to all of this is maximizing your non-payroll expenses, okay? And minimizing your payroll expenses as part of that forgiveness package. You want to get as close to 60% for, you need to be at minimum 60% payroll expenses, but you want to keep it as low as possible and try to find eligible non-payroll expenses to make up that 40%. Now think about that. I've had many people say, well, it's just simple. I just send in all of my payroll to cover my PPP loan. Well, if that was a $100,000 PPP loan and you used all 100,000 for, just saying it was wages, you literally left $40,000 of qualified wages on the table that could have been used for the employee retention credit. And that adds up significantly. Excuse me. By doing it this way, and this is why we have a whole PPP loan forgiveness division dedicated to helping businesses sort through this. But what we're seeing is typically a 10 to 20% increase in ERC funds using this approach, as opposed to just throwing all of your payroll at that PPP loan forgiveness. Can't stress this enough. How you approach the PPP loan forgiveness impacts how much money you can get through this program. So I'm going to end with a true story. Call this the tale of two brothers. And these are our clients. It's two brothers. They live in central Pennsylvania, and they each own and operate a sports bar on either side of town. And they do everything pretty much together except run their sports bars. Well, anyways, the two brothers both got a PPP loan. They were both significantly impacted by the pandemic. They're still struggling. We're still helping them through this, but they got their PPP loan. And one of them just took the easy way out and said, I'm just going to throw all my payroll to, my PPP loan forgiveness. It seems simple, that type of thing. And the other one said, oh, hey, I'll just itemize these things. Took him a little bit longer to do, but he itemized the non-payroll expenses. And when we took them through their eligibility exercise, and when we took them through their calculation for their employee retention credit, the one that I just identified their non-payroll expenses got $10,000 more than the one who just threw in the payroll. Now, for a small sports bar in central PA, that was huge. That was a game changer for them. And, that the one brother who just said, hey, just didn't know, right? But that's how meaningful it is, knowing how you do that PPP loan forgiveness. It's real dollars. It's real impactful. It was really the difference for those businesses to be able to continue to operate and actually add on some catering services. They had the capital to do that. And the other brother missed out on it. Now, I guarantee you, they both got the second PPP loan, and they said, hey, Jonathan, we're going to make sure we do this the right way this time, whatever we need to do to maximize our employee retention credit. So it's a lesson learned. And for those of you who either haven't filed their PPP loan forgiveness for the first one or are looking to do this for their second one, make sure you maximize your non-payroll expenses. And if you have any questions or want some help with that, just let us know. So open it up to questions. I was a little long-winded. There's a lot of material. I do appreciate your patience. So hopefully it was helpful and meaningful. And so I'm open for anything specific or general.
I'll open it to the floor. Yeah, go ahead.
Does fuel, if you're a service company that uses trucks to go out to people for your job, is fuel considered a non-essential, a non-payroll expense?
For the purpose of the PPP loan forgiveness?
No, to get for my non-payroll expenses, to get that down, can I include fuel? Because we use trucks to go out to job sites constantly for emergency services.
I would have to look at your specific use of those vehicles and how that fits in as a supply for an end use component. Does that make sense?
Yes.
Like if you can if you can tie the fuel directly to the end product or end delivery, it's a possibility. If it's just tied to being able to get a vehicle out for an unrelated service, then it's unlikely for that. But we can certainly research that for you.
Yeah, because if somebody has a major flood in their house or a fire and we have to get out there and clean it up, we take our trucks with all the equipment.
Absolutely. Absolutely.
To me, that's getting this product out there for the end use. We also do
part of this is actually, we get questions like this is if it's an unknown, we're going to take it through our review and give a determination of how comfortable we would be in terms of arguing this if the issue is raised.
And I can understand that sales reps, or if you're just going out to do an estimate, yeah, that's not an end use. That's different. But the actual physical trucks, because when I get a gas receipt, I tag it for that vehicle. So I can pull each vehicle up and just pull their fuel up.
For the specific service, correct?
Right, a service vehicle. I could pull each service vehicle up and I could do a search and print off a report for each service vehicle.
Well, Janice, I'd be glad to research that for you and give you a specific answer on this. I don't know that one specifically in terms of that and that use case.
Thank you. I have one more question. If you've already filed for forgiveness of your first PPP, you can't go back and do this ERC?
Well, you can do the ERC is we can't use the qualified wages that you identified as part of that loan forgiveness packet.
But on the
now, that also comes down to how the bank used your application. Mm-hmm. If you were under 150,000, just by identifying some of those non-payroll expenses, even if they weren't necessarily reported, you are eligible because it wasn't a requirement as part of that application process. Okay.
With our second PPP though, we can.
Absolutely. If it's over 150, it comes down to reporting requirements by the SBA.
Yeah, we're under 100. We're under 100.
So if you're under 150, all you were required to do is maintain local records of those non-payroll expenses. They weren't necessarily a reportable item to your bank for the loan forgiveness. That is a case-by-case basis of how your bank handled the application.
Okay, thank you.
Sure.
Other questions?
Doug, I have a question. It's Howard Baskin.
Howard, go ahead.
If in April of 2020, you did lay off people because of the drop in revenue, but you retained a bunch of others, do you qualify for the ones that you retain, or does the fact that you laid off people in April 2020 disqualify you?
Howard, that's an excellent question. I get asked that frequently. So, and I think you're also referring to in the PPP, you have to report how many jobs you kept or maintained or increased, right? There's no employee count requirement associated with the employee retention credit. So you will get, it's based on the wages paid, strictly the wages paid during that time, regardless of the number of employees. So you'll get the credit for any of those that you kept, and you're not getting punished for any of the ones that you had to let go during that time. And if you bring them back at some point during 2020 or early 2021, you'll get credit for those wages as well.
I'd very much like to pursue this with you. How do I do that?
Well,
I know that they're in the chat that somebody has put up the most recent flyer. So if you go into the chat, if I understand that correct, can you look at that, Jonathan, and see, or Vince, and see if that's correct?
Yeah, it is correct. And the idea here is that there are a lot of this money is going unclaimed because small businesses scared of the IRS, the complexity, whatever the problem is. Our job, and thankfully we've got the chamber here, is to be able to help navigate our way through this. We are fortunate to have one of the leading processors for this type of work in the SBA in the country happens to be right here with Johnson's expertise. The good news is that Jonathan is donating back. This is going to help not only small businesses, but also our families. And we're putting the money that comes back into projects and working with Doug back into the local community. So please call the number that is in the chat. Doug, of course, has the flyer. It's been published before. When you do that, though, you're helping not only your business, but you're also helping all of us and the local community here.
And if you want to reach out to me directly at the chamber, they've emailed me the most recent, and I will get that turned right back around to you. So,
yeah, I just want to just throw a couple of words out there, just thanking Doug and Vince again for this, because it's really the community working together towards this, because as Vince stressed, there's a lot of questions around this program. There's a lot of concern. There's a lot of misinformation. I can't tell you how many businesses I've spoken to who don't think they're eligible, or were told that they were eligible because they had old, outdated information, or they were given bad information by someone that they deemed knowledgeable in this. We've been actually doing this way longer than I think anyone out there, and it's important that we, as an organization, and I think it's core and fundamental to Emerge 180 as well, in terms of giving back to that small to medium-sized business community. So I couldn't be more excited about working with Doug and with Vince on spreading the word here locally.
Okay, I'll ask a question from a chamber perspective, Jonathan, and I don't know if there's an answer to it or not, but we have a vast variety of types of businesses, restaurants, hotels, service industry. Do you see that there's one particular type that might benefit from this more, so we can then turn around and reach back out to those people that weren't on this call, or is that kind of a
it's good. I would stress what you just highlighted: the hospitality industry, the fitness industry, the retail. Pretty much if you're located in Pinellas, Pasco, Hernando County, you're eligible for this credit if you're in hospitality, if you're healthcare related. Even if you're a law firm. I mean, I will tell you this: there's those three that have a high eligibility rate, and you may say law firms. Well, they were impacted by this. They're not able to, because the courts were closed. They weren't able to get hearings conducted. They weren't doing a lot of things. So we've qualified a ton of law firms as well. But hospitality, your restaurants, your retail locations, those are all ones that they have a very high eligibility rate. And I can tell you this: if you're in Oldsmar and you're a bar or a restaurant or a yoga studio or any of those, your qualifications go from March 12th of last year up to May 4th of this year. Okay, I can tell you that right now. You have almost 14 months of payroll that you could be eligible for with this.
That's awesome. James, from your perspective, James is the CEO of the Titi Rodriguez Foundation and the golf course. Do you see an opportunity? Because I know it's been tough for you guys to navigate some of these programs. Do you see any opportunity from your side, James?
Yeah, I had actually a question for Jonathan in regards to percentages and increase of revenues. So as Doug said, we operate multiple businesses under one umbrella of the Titi Foundation. So the golf club and the driving range over that time period, we stayed open the whole time. But our public school, our partnership school closed. But the golf club and driving range did okay, but our fundraising side did not. So, I don't know if, how long you go back as far as comparing revenues over previous years, if it's just 12 months or if it's 24 months or 36 months, and how would that compare if different businesses didn't perform well? We were still probably slightly ahead, but not much.
So, okay, so if they're all under the same entity, like have the same EIN, then it's just one component. If that's eligible, applies to all of them. It becomes a little bit more complex if you have different entities, like they have different tax IDs and so forth. Then it goes into what's called an aggregation formula. So if all of these are under one entity, all we need to do is qualify one component of the business to make the whole organization eligible. The second part about that, in terms of your fundraising, for the 2021, the 20% decline does apply to what you're talking about in terms of fundraising. Okay. The IRS has made it very clear that tax exempt organizations are eligible for this, and based on their fundraising as being like a business-like transaction. So the comparable quarters, they do it by quarters. The comparable quarter for 2021 is 2019 if you were in business prior to January 1st of 2019. So if you want to take your first quarter, James, of 2021, you need to see what your fundraising was in the first quarter of 2019. And if that decline was 20% or greater, you are eligible for the credit based on the gross decline in receipts clause.
Yeah, I think we would be looking at 2020 and maybe the third or fourth quarter of 2020.
Okay. Well, for 2020, you have to exhibit a 50% decline.
Okay.
So that's where they changed the guidelines a little bit. But, so it becomes a little bit more difficult to qualify by that. So what we may want to do for 2020 is look at the whole organization and say, well, maybe you're eligible, based on some type of partial suspension. You mentioned like the school being shut down or some other components of this being shut down that would make you eligible for that. And I will tell you this, we've had several clients that qualify under a partial suspension in 2020 and maybe the first part of 2021, but then are eligible in the following quarters because of a decline in gross receipts. So it's not one or the other. Okay. It's a combination of those things.
Yeah. Yeah, I mean, from a golf course standpoint, we did stay open, but we obviously limited the number of tee times available, and everybody was taking individual carts. So from an operations standpoint, those businesses were impacted.
Understand. No, I think it's definitely worth looking at further, for sure.
Okay, we'll be in touch this week at some point.
Sounds great.
Other questions? I'm a lot to absorb here, Jonathan, for sure. So, and I will ask that, this is just a small percentage of our chamber businesses that are on here, and also non-chamber people. So if in your daily goings on, if you run across somebody that this might be applicable to, feel free to share that or get them to me, and I'll get them a copy of this thing so that we can touch as many people as we can with this. So I think we have a ton of businesses that are in our chamber footprint that this works for. So we just got to get it out to them.
Doug, could I ask one more quick question?
Yes, sir.
Jonathan, on that math you just did, if I'm looking at Q2 2021 to see if I have a drop, am I comparing it to Q2 2020, or am I going pre-COVID to Q2 1919 or 2019, which is where the real drop is?
Your comparative quarter is Q2 2019.
Thanks.
Hey, Jonathan, I had a question for you.
Yes.
Thomas?
Yes. I have a lot of businesses I'm sure that would probably be beneficial for. I pass this information on. Is there a fee for a company coming in just to see if they're eligible, and if they're not, are they going to have to pay a fee on top of that? Or
so how we do this, there's a $100 admin fee that just covers our infrastructure, postage, and delivery. But I will tell you this, if they answer those first three questions, say under 500, paid W-2 wages, and we're in business prior to December 31st, they get started on this. If we're deemed that they're ineligible for some reason, or we can't qualify them, then if we've even charged the $100, we'll return it back to them. So they're not going to be out anything.
And so if they are eligible, this is the next question that I'm going to get from them, all of them. What is your compensation for it? Is it paid right up front or after they get paid?
Yeah, so we take a percentage of the amount of the credit, and you do not pay us until after you've received the money. So we're in it with you. So as soon as you receive the check in the mail, then that's when our fee is due.
Absolutely. That's great. Thank you.
Other questions from the room? Some great information.
Yeah, and thank you, Thomas, for asking that question. I did not address that in the presentation.
That's the question that everyone's going to ask me. So
Right, exactly.
Before saying so, thank you.
Well, again, check in the chat box or email me at the chamber, dbeavis@utbchamber.com, and we can get you that flyer. I'm looking around the room. Some people don't have their cameras on, so if you don't have your camera on and you have a question, go ahead and unmute yourself. We'll give it a couple of minutes. Okay. Good. Well, I think this was a wealth of information. As I said, I recorded this and I will push this back out to, I'll put it on our YouTube channel, and I'll get the link out to as many of you as I can to share with people that may not have been on here but might benefit from it. So any closing words from Jonathan and or Vince?
No, just a general thank you. That this idea of navigating this complexity is what we're trying to do. This is all about helping, saving small business, and making sure that if you have issues that we knock those things down. We are extraordinarily fortunate to be where we are geographically, and to have the kind of infrastructure, Doug, that you've helped put together here, and lucky to have Jonathan so close. Real expertise. So thank you very much.
Yeah. But I think it's awesome. And I obviously I'm going to reach out to Nick Pappas, who owns Flamestone and Beechwood. I know he was affected by this, as were a lot of the restaurants, probably, I assume, hotels and fitness studios, like you said, Jonathan. So we'll definitely be reaching out to them to make them aware of this program. And my head was about to explode trying to understand it. So you definitely want to have a Merge 180 navigate through this. So they're the experts at it.
Thank you, Doug. Appreciate everyone, and particularly you putting this together. So
yeah, thanks. And maybe we'll do it again, or we'll push this out. So I appreciate it. And if anybody has any questions, do you have an email or anything, Jonathan, that we could push out there, that if they have a question, they could reach out to you directly?
Yeah, do you want me? I'll just put it in the chat box.
Yep, that'd be great.
So
perfect. Excellent. Any other questions?
Thank you, everyone.
Before we end it? Awesome. Thanks. Appreciate it. Thanks, Vince, and thanks, Jonathan, and thanks to everybody for being on the call.
Have a great day. Stay safe.